Hello, this is Rob Tennyson, aka Rob Your Lender. Today we're going to be going through a loan estimate, how to read it, what it all means, and kind of breaking down. Today I actually have, this is a real loan estimate for one of my clients. So we'll go through it, what it really means, but I've got all their information blacked out. So let me share my screen. So here we go. This is what it looks like. And so we'll start right at the top. This is the first page. It's one of 3 pages. The first 2 are really the important ones. I very rarely look at the third one. It's just kind of required disclosures. Let's zoom in so we can see what's going on. So at the top, you will see your company and the address for that company. You'll see the date that this loan estimate was issued. Here will be your name, address, and the property that it's for. If it's a purchase, you will see a sale price here. If you're doing a refinance, they will either have nothing here or they'll have the estimated value right there. The loan term means how long is this loan going to be enacted. So this one's a regular 30-year loan. So that means if they make their minimum scheduled payments for the next 30 years, the loan will be paid off in 30 years. The purpose of this loan, again, is a purchase. They're not refinancing, they were buying a property. The product type is a fixed rate loan as opposed to an adjustable rate loan. So this means their rate is fixed for the entire 30 years of the loan. If it says ARM, that stands for adjustable rate mortgage, or it will say adjustable, something along those lines, if your rate can change through any time in the 30 years of this loan. Loan type, there's a lot of different loan types. The most common one is conventional. This one's actually an FHA. It's great for first-time home buyers, a little bit expanded guidelines, still insured by the government, so still a really good loan. And you got VA loans, which are great for veterans. VA loans are, in my opinion, the best loan you can possibly get. And then there's a variety of other ones, USDA, non-QM, jumbo, all this different stuff. We're just doing, this one's an FHA loan. But again, the most common one is conventional. Then you'll see your loan number. That will be right here. It's also on a variety, I think it's on every single page of this document. You'll see your loan number and rate lock. So this one was not locked at the time of this disclosure, meaning that we were subject to interest rate change movements in the market, meaning interest rates go up and down every second of every day, just like a stock. And until your rate is locked, you are subject to market changes. So luckily for this one, the rates did move down just a little bit right before we did lock in. So they have locked in since since rates have now gone up since we locked in, but we did capitalize on a couple more gains of positive market days, meaning lower interest rates. And if you have a mortgage advisor and a team, you can do those things. I look at the mortgage market every second of every day, make sure that my clients aren't missing out on any potential savings and protecting themselves from any future losses. And so, again, this is the loan terms, loan amount. So you'll see 751, 143. So you can kind of calculate your down payment. This one's going to be a little bit different because FHAs have what's called upfront mortgage insurance premiums, meaning that they have additional mortgage insurance that's financed into the loan. So you'll see most FHA loans are 3.5% down. So you'll see 765. And so the opposite of that means there's 96.5% of the total price. So times 0.965, that's the base loan amount. So that would be what their down payment is. But they have mortgage insurance premiums that are financed up front. And that's why this number 751 is higher than the 3.5% down would be. This is their interest rate and their monthly principal and interest. This does not include taxes, insurance, HOA, mortgage insurance, anything like that. This is just the mortgage portion of their payment. Most mortgages do include taxes and insurance within their payment. That's called being impounded. So you don't have to, pay your mortgage and then pay your insurance and then pay your taxes all in separate bills. They keep it nice and conveniently all in one, and it really helps keep things simple. This is pretty rare you see any of these unless you're doing some kind of non-QM or jumbo loan. This will almost always be no. Prepayment penalty means that they can pay off this loan anytime they want in the next 30 years without having a penalty issued to them. There are some issues if you pay it off before you've made the 6th payment. So within your first 6 months, it's really 7 months because you skip a payment. So if you make a payment pay it off within the first 6 months, then you might have some problems, but it won't be a penalty to you. And balloon payment means that say this was an adjustable for 10 years. After 10 years, they had to pay the remaining balance that's left in the loan. So no, this means that it's fully amortizing. If they make these monthly payments every month for the next 30 years, they will have a 0 balance on their loan. There's no prepayment penalty for them paying off early. All right, here are the projected payments. You can see that this monthly principal and interest, the same number right here. So they also have mortgage insurance, so monthly mortgage insurance, as well as the upfront mortgage insurance. It's financed into the loan for the 751. So you got monthly mortgage insurance at 653, And the estimated escrow items, which means the taxes, insurance, any other kind of fees like that that are not controlled by the mortgage company, that's what this is. Typically just taxes and insurance is what this is going to be. And so it says amount can increase over time. That's because you can get higher, your insurance can become more expensive. In some states, the property taxes actually go up regardless of when you bought the property. In California, that's not the case. Your property taxes stay the same as they were throughout the entire life of you owning the property. The other states, it's not the case. And then they add it all up for you. So this is what their real monthly payment is going to be, $6,626. And that includes the principal and interest, mortgage insurance, and their estimated escrow items. And you can see on this one what is included: estimated taxes, insurance, and assessments. And again, they reissue that this amount can increase over time. So they have 1,252 because they do have an HOA in there. The HOAs are very rarely escrowed. Are they in escrow? Same thing as being impounded. Means that it's not part of the $6,626. You usually have to pay your HOAs outside of your mortgage statement. So you will pay your mortgage statement, which will include your taxes, insurance, mortgage insurance, and then you'll pay, if you have HOA dues, those will be paid outside of your mortgage statement. And then the next page will show more about how these escrows are paid and what the cost of those individual items are. Closing costs. This is just a summary of what all the closing costs are. So their total closing costs are $34,362. It includes $26,375 in loan costs, $7,987 in other costs, and $0 in lender credits. And see page 2 for details. So we'll go through what all that really means. And then the estimated cash to close, this is actually the out-of-pocket that they have to give to buy this house, $33,219. And again, this is going to be in much more detail on the next page. So this first page is really just a summary of everything, and then the page 2 will go through in more detail. So here we go. So we're going to go from A all the way down, left column first, then right column, so loan cost. Most places are going to have some type of processing or underwriting fee. This is a fee that goes to the lender to pay their operational staff. The people who collect all the documents, who approve the loan, sometimes even the disclosure team gets their pay out of the stuff, but most places will have a processing or underwriting fee. Ours is just put in one, and it's $1,750. And they are paying 0.809 for loan points. Means if you have to pay any kind of discount point to get you a lower rate, or if there's a premium to get that for whatever loan scenario you have. This one came with a 0.809, so you can kind of calculate that one out. 0.809 times the loan amount is $6,077. That's how much they have to pay. We were actually able to, after this was issued, talk to our management team and our concession team to get this fee waived for them because they were a referral from one of our trusted advisors. So this is, it's showing this amount up front, and these things can change as they move forward, but it's always a negotiation process with your loan advisor and the branch and the people who are in control of the margin, the concessions, and all that stuff. Services you can shop for. So this is all the different things that you technically can shop for. Some of them are, it says you can, but like technically you can't. For instance, condo approval documents, there's only one place you can get those. That's for the HOA that you're buying a house from. So you can figure out how to go get that. You can do it in different methods, but you have to go get them. And there's only one place to get them, and that's $500 for them. The one that's pretty consistent on all loans will be the appraisal fee. $600 is what it was for this one. That will go on, be different amounts for different properties, different sizes, different locations, depending on your market, wherever it is. That number varies pretty greatly. I've seen it, in the thousands, and I've seen it, just $400 or $500 before. Credit report, digital closing fee, flood cert. So this is all the stuff that's we have to order a lot of different validation services in order to get a loan done. That's what these are. HOA master policy, it's very similar to condo approval documents. So the very common ones are going to be appraisal fee, a credit report, digital closing, flood cert, MERS registration fee, and then tax service fee. Those are pretty standard on just about every loan that you'll see. You'll get those ones. Again, this one's a FHA loan, so they have a mortgage insurance premium, and this is what was financed upfront and put into the loan amount. Oh, sorry, this was services you cannot shop for. So these are ones that are ordered by the lender, and this is the ones that you can shop for. This is title and escrow. The way it works in California is that the seller will typically pick title and escrow. It states in the contract how it goes down, if it's going to be the seller, or if you can choose who you want to use. But most of the contracts I see for purchases do say that the seller will have their choice of escrow and title. And these are all the fees that are charged by the escrow and title company. They typically just label them title, and even though some of them go towards the escrow company and some of them go toward the title company, you might be in a state that doesn't even have escrow and title companies. You'll have a lawyer fee instead of title insurance and doc fee and all that stuff. It'll just be, a lawyer fee of $2,000, whatever it may be. So this will vary greatly depending on where you're buying a property or where you're refinancing. If you are in an escrow state, these are the ones that are pretty standard. The large ones that you're going to look at a lot are the settlement fees. So it's also called the escrow fee. And that's basically the big fee that escrow charges for their services to make sure everything's correct and money's sent to the right people. And then title insurance, that will make sure there's no liens on the property when you get it. Nothing that's not supposed to be there. The only loan that goes on that property is the one for the mortgage. You'll have a notary fee, loan tie-in fees, all these other different smaller fees that go into getting your loan done that are charged by escrow title companies. And those will vary depending on where you are and what escrow company you choose, and so forth. And so they add them all up for total loan cost A, B, and C. And that's what we saw on that previous page, $26,375. So that's what they mean by loan cost. These ones. And so the other costs, these will be ones that are not lender related, escrow or title related. So this is taxes and government fees. This is for recording your title and showing where the property is on the county assessor's website. This title company will do this for you on the purchase, and their estimated charge is $149. In California, we have what's called transfer taxes. These are $803 for this property. These are also typically paid by the seller. So it'll show it here because it's a buyer fee, but in California, it's what's called a seller obligated fee. So it'll show it to you up front, but the seller will pay for it. And it'll state those things in your purchase contract. It's kind of one of the minutiae details that most people don't typically see. If you're buying a new build, a lot of times they have their own purchase contracts. And so those seller obligated fees, they push those over to the buyer. And the trade-off is kind of hopefully that you're getting a really good deal on a new build. And those fees will offset into future equity in the home because they're giving you a good deal on the house. Prepaids, this is what you're paying for up front so that you don't have to pay anywhere else. It's all going at once. So when you pay insurance, you pay everything all up front for the first year. So that's what you get, $1,502. That's going to cover your next year of insurance premiums. And then after, you're going to start paying monthly insurance. So that by the time your premiums due next year, you're going to have 12 months and a little padding in there for when the next 12 months is due. And you also have prepaid interest for the days from the day that you close all the way through the end of the month. So if they're funding 8 days before the end of the month, so if it's the 30th, the end of the month, then it would be the 22nd is when they're closing. It's the 31st, they're going to close on the 23rd. So you pay those days up front, and your mortgage interest is actually paid in arrears. So it is November. So if they close at the end of November, they're actually not going to make their first mortgage payment all the way until January 1st. And that January 1st will actually be calculating the interest you pay on that January 1st payment will be for the interest earned, issued, whatever you want to call it, for the month of December. So you pay your interest for the month prior. I know when you pay rent, it's the opposite. They make you pay for your month, and then that's good for the next month. When you're paying a mortgage, it's the other way around. When you pay interest, it's actually for the month that just happened. So that's why they're going to pay 8 days of interest for the remaining days in November. And then on their January 1st payment, they're going to pay for interest all the days in December. So that's what prepaid interest is, will be the remaining days in the month that you are closing your loan. And the initial escrow payment at closing, this is, again, some of that buffer so that the next time your insurance premium comes due, they have 3 months buffer in there in case your insurance premium goes up, something changes, or any of these other fees go up. So they're a little bit protected. They also have your property taxes in there. So they calculate, they estimate what your property taxes are going to be because the county will reassess them usually within 6 months of you purchasing the property. In California, we do 1.25% of the purchase price. That usually covers it, usually a little bit too high, but you'll get it at the end of the year. You would get a refund check if there's too much money in your escrow account. They'll just send it to you. They're required by law to give you any overages. So it's not like they're going to hold it in there or take it from you. If they end up with too much money in there, they're required each year to do an assessment of your escrow account and give you any money that's extra. So in where we are in California, taxes are due in March and November. So they calculate so that you have 6 months worth of taxes every March and every November. So they'll do what's called an aggregate escrow calculation to figure out how many months of taxes they need in order to get that done. And when you do a refinance, this won't say 3, it'll be a calculation based on when your insurance policy is due for renewal. So if it's closer, it'll be a higher number. Say we're funding in November, say your insurance policy is going to be due in February, this will be a higher number, like 10 or 11. But if it's not due for a year, just like this one, it's going to be a lower number, 2, 3, 4, something like that. But again, this is all going towards your escrow accounts, not money that the lender's collecting. This is going towards an escrow account that will go towards paying your insurance and taxes. If there's any overages, it will be analyzed every year and you will get the extra. All right, so there's no other costs on this one, and this will be the total other costs. They kind of add these different ones together, E, F, G, and H. And then total closing costs, they add I and D from this page. So you can see I and D, these two add together, $34,000. The total closing costs that we saw on the other page. If you have any lender credits on this loan, which is actually the opposite of what we saw in section A. So this is a discount point. If there's any lender credits, it's the opposite of having this. So you could get a higher rate in lender credits, or you can get a lower rate in pay points. There's never just, this is one rate. There's almost always two sides of the coin. And in today's market, there's usually only one way to do it. It's to pay for points and lower, just because how everything's are, but things will change years to come, and there will be more lender credits and more availability for that. So this is calculating your cash to close, how this is all going through. So they got the total closing costs, the down payment funds from borrow. So this is what they put in on their earnest money deposit. When you sign a purchase contract, they'll usually say, hey, we're collecting X amount of dollars. It's usually a percentage of the purchase price up front to show that you're a serious buyer and you are going to be committing to purchase this property. And so that's what they paid for already. They already put that into escrow to go towards the down payment and closing costs. And then they also had seller credits. So they were actually able to negotiate $15,000 in seller credits. And so 34,362 plus 13,857 minus 15,000 is their estimated remaining cash at close, 33,219. And on the third page, again, this is not one I look at typically too much, just because it's not very useful information. In 5 years, this is how much you will have paid in principal, interest, and mortgage insurance and loan costs, and then you will have paid off $43,144 in just principal. And so for loans like this, where you're not putting a whole lot down, I usually recommend putting a little bit more down so you can get to that 20% equity number. And I mean, like, you know, do it consistently and do it small. So do it $50 a month, maybe $100 a month if you got that, until you get to that 20% equity position. And the annual percentage rate, 8.562. This is the interest rate plus all lender-related fees as a percentage of your loan amount. I don't typically recommend that buyers use this number in comparison, which is really what it was made for. It was made so what the comparison I use is that it's like going to the grocery store and shopping for chicken, and you see like a price per pound. So even though different amounts will come in different weights, you can see, okay, this chicken's worth this much per pound. That's what APR is supposed to be. So it's supposed to be a way to easily compare loans. But there's certain fees that are APR fees and certain fees that are not. And unfortunately, there's some unscrupulous lenders out there that take APR fees and mark them as not APR fees. Their compliance team thinks it's differently, or whatever it is they think they're doing, but the APR is not really as reliable. It was made to be. It's a great idea, but it just hasn't been enforced well enough for it to actually work as a comparison tool. And then the total interest percentage, again, not a number I look at very often. It's the total amount of interest you will pay over the loan term as a percentage of your loan amount. So it's 142.695%. So if they were to actually hold this loan for 30 years and just pay it, don't pay it off early, minimum monthly payment every day for 360 months, which is 30 years, they'll have paid 142% of what their loan amount is in interest. So more than double what their loan amount is in just interest. And then there's just some other considerations. Again, not stuff I typically look at. I'm usually just looking at page 1 and 2 to make sure all those things are correct. These are pretty boilerplate stuff. Servicing, we intend to either service your loans, they're going to hold on to it. This is most places will not hold on to it. They'll transfer servicing of your loan. So servicing means who you're going to make your payments to. So what happens a lot of time is your loan gets closed and funded. You'll make 1 or 2 payments to the entity that closed your loan. So in our case, American Pacific Mortgage, you'll make 1 or 2 payments to us until we sell the loan and sell the servicing to someone else. We also have what's called sub-servicers. meaning that we've contracted these companies to do servicing for us. But it's really, unfortunately on the front end in sales and as a borrower, you don't have much say in where your loan goes. It's all kind of a secondary market that happens in the back end. It's not going to affect your price of your loan, your interest rate, anything like that. It's really just what company are you going to be sending your payments to. And like I said, most of our loans do get transferred or sold off for different servicers. So yeah, and then here's where your signature will be. Most of the time this will be a DocuSign. So you don't have to actually print this and sign it, but it'll have your name and date. And then on the next page, if you have any co-borrowers or any additional signers, this is where they will sign. And that is the last page. Yep. So this one had 4 pages because there's one additional for the co-borrower. So we've got page 1. It's a good summary of everything. Got the loan amount, interest rate, and the monthly payment, and then the closing cost and remaining cash to close. And then page 2 is a closing cost details. This is a breakdown of all the closing costs. You can kind of see what's going on there. And a big one for them is the seller credits, which is why it doesn't look so hefty on them compared to their down payment. And then page 3 is just kind of the government required stuff. And then your signature and co-borrower signatures on the next page. So that's all. I hope that was very helpful. If you have any questions, feel free to send me a message or comment below, and we'll see if we can get those answered for you. Thank you.